Hello, everyone, and welcome back to 4C Markets. I am your host, Alejandro, and this is my co-host with me, Serhii. Please, Serhii, if you can introduce yourself as always.
Hello, everybody. I think everybody knows me already, Alejandro.
Let's
So
hope so.
basically, today, I think we have a very interesting topic to talk about. So all the markets are going red, right? So can you tell us like what's going on the market? What's the current situation? Why everything got that bad, as some people say? And what can we do about this?
Yeah, so this is basically what we're gonna talk about today, right? And it's not necessarily like a bad thing. I mean, it's bad if you're long, but if you're short, this is a really good thing for you, right? So this is it's always relative with the markets. Like, are you long or are you short? And for anyone who doesn't know, so there's like basically four market principles that are relatively easy to understand. You have a bull market and a bear market, and then you have long positions and short positions. So a bull market is when things are going up in price. A bear market is when they're going down in price. A long position is where you set up so that you benefit if there's a bull market, so if things are going up. And then a short position, you benefit if things are going down. So everything is relative. So then how do you
Very
position
easy
yourselves?
to remember, like if there's a bull, so basically, as traders say, he takes somebody when it's yeah, how
Right.
to say it, like about
With the
and to
horns
push
and
things
it's going
up,
up,
and if the
right?
bear just makes it
And then
down.
the
So
bear
yeah,
just takes it down, right? Exactly. And so that's
so this is
what you
easy
need
to remember.
to exactly. And this is why, you can always be on the better side of the coin. Like, are you on the side of the coin that things are going down or on the side of the coin for things that are going up? So this is what we're going to be talking about today. And as always, we have charts to show because that just kind of, shows what we want to tell. This is the chart for the S&P 500 over the last month. So we started the month about 7,530, and now we are at 7,373, and we are on June 26th, so almost the end of the month. We dipped as
So this
low
is
as
Standard
7,000.
10 Poor's, right?
This is the Standard and Poor's 500. So this is 500 companies brought together to create an industry and a sector conglomerate that, when added together, give you a number or a benchmark to follow. And so this is a very widely used number, and it's created by Standard and Poor's. They decide who goes in and who goes out, and they have a lot of requirements for you to be able to enter this group. Well, once you enter this group, you're basically saying, I am a really good company and I deserve to be treated as one of the top 500 companies within the United States. And within the United States is relative because, we have global markets. So although you might be doing operations in the United States as your official headquarters, you may be getting materials from Tokyo or from Korea or from another country. So, everything's relative, right? If there's exchange rates that change, then the cost of getting things is going to fluctuate. So why are the stocks markets changing right now, and what's actually changing? So for anyone who doesn't know, we have a new Federal Reserve chair, Kevin Walsh, and he has new policies that have been created. And usually when you have a new chair, you end up with volatility. And that's what we're seeing right now. The other thing is that, we were kind of expecting that rates would drop when the new chair took over, but rates actually didn't drop. So because of that, the cost of borrowing money is higher or equal. And so all of the people who were betting that the rates would fall are now having to sell their stocks because they need to get back money that they would have borrowed for bridge loans or things of the sort. So a bridge loan is like a short-term loan that you borrow in order for you to complete something. So let's say, for example, you want to buy a house and you're saying, I'm going to buy this house once I sell the other house. But then the person selling the second house says, I'm not going to sell this house to you until you have cash. So you say, well, I'm sure I'm going to be able to sell this house within the next month and I have a really good deal of this house. So when I do the economics, it is better for me to borrow money very short term so that I can sell the house, pay off this loan, and then buy the new house. And then the new seller, the seller of the new house, doesn't have to wait. So that's called a bridge loan. It bridges the gap between the money that you need and the transaction that is waiting to happen. So if we look here, like we see here there's sort of like this peak here at 7,600 almost, and then another peak here at 7,575, and then there's this big valley that happens, right? So this is basically the sell-off that are taking place. And then of course people see that there's a sell-off, so then they start to buy again. This is what happens when people are trying to create, or when selling has pressure and there's more urgent sales than there are more urgent purchases, right? So because there's people who need money, they're trying to sell quickly, and because there isn't enough buyers, they're trying to drop the price until the buyers decide that this is an attractive price and they start to buy again. So because interest rates didn't go down as was expected, then we start to see a decline in the overall market to where now we're at $7,370 for this SP 500 benchmark that we're following. So that's just this one, right? Now, if we look at QQQ, which is Invesco Price Series for the NASDAQ, we see a very similar pattern, right? So the indications of this tell us that basically it's market wide. So if you're invested and you see that you're losing money and you're invested long, you're probably also looking at this and going like, well, what happened? So it's market wide. It's not that you made a bad investment. I mean, unless you just bought something not, very profitable. Like if you invested a ton of money on GameStop when it was like $1,000, then maybe you should, be questioning yourself. But if you just happen to be, doing your due diligence and you see that there's a drop, it's not just you. There's just a lot of people who are doing this. One of the other drivers that we have is the semiconductors. So this is the Bannex semiconductor, and at the start of the month it was at 599. Now it's at 620. So there's just a lot of volatility in this as we see. But anytime that there's like a massive drop off in price, like here's at 668, and it drops all the way to 634. And then it just continues to rebound until you end up with 619 about right here. But if you look at the volume, right, the spike in volume is happening when the opportunities come. So from here to here, there's just a huge drop. And then you have about like 300,000 shares within this 1 hour. And then it continues to drop, but the number of shares that are being traded is less, right? Like there's less shares until finally people start to say, okay, this is like my sale pressure. So they buy a little bit here on this space at about, closing or getting close to closing, and then they start to buy again, but eventually like it levels off. So this is the semiconductor space. That's where like a lot of money is being thrown in and getting out. And this is all related to AI, which brings us to what's happening next. So we are seeing a rotation in money, right? People are, for example, here taking money out of technology, XLK, as you can see here, like everyone starting around right here, right, the 22nd of June. We see that a lot of people start to get out of semiconductors and just technology in general, and they're putting the money back on safer spaces, which is XLU. XLU is utilities. So if you notice here, there's a anti-correlation where one is going down and the other one's going up. What does that mean? That means that people are taking their money out from semiconductors and technology in general, and they're putting it in utilities, which is a more safe bet most of the time, right? Unless, we see another money rotation where people might be putting it on energy. But in this particular case, a very good example of what happened is that everything, like things were traded pretty steadily, and then all of a sudden there's a huge drop in the technology sector, and then everyone who sold, or not everyone who sold, but a large majority of the people that sold started putting their money on utilities, and that's what the utility sector starts to go up. So then we look at the VIX. So the VIX is the is the volatility benchmark, right? So like this is how much volatility there is in the overall market. So this is like the S&P 500 market. And whenever this is going up, whenever we see a large sell-off, we see that the volatility is spiking. So as you can see here, like over the last 1 month, it was pretty steady and it was going down at the beginning of the month. So if we look here at the S&P 500, the beginning of the month, right, it's going up nice and steady, and then boom, drop. So if we look at the VIX, right around the same time, you see all of these spikes, right? So that's what this trend tells you. So it's actually really interesting because if you're an investor and you are following these trends, this tells you which position you should be in. Like if you are a person who is trying to make money on the dips, you want to put money when you start to see spikes like this, because as soon as you start to see spikes like this is indicative of a drop in the S&P 500. That's where you start to see things like this happen, right? Because if you put money here and you're short right around June 4th, and then you sell it all the way to like June 11th, you would have made a lot of money, right? So that's what happens here. We go here, we start to see June 4th, price starts to go up, and it continues to be like this until it starts to level off around day 11. So this is following that trend, almost like 1-for-1. But the causality that goes on this is like when you're measuring the VIX, it's happening at the same time as the volatility in the S&P 500. So if you want to try to catch this, you have to be like very attentive. I don't trade on this, but I do pay attention to try to understand why things are happening so that I know what moves to make. But I don't necessarily trade specifically on this particular marker. Next thing we're going to be looking at is the 10-year T-note. So as we see here, the prices for this went up right around the same time as the S&P 500 was going down. Why does that happen? Well, when people are taking money from one system, they're going to try to put it somewhere else. So if it's safer to put it in the government bonds because they have a higher yield, then people are going to measure and they're going to say, it's going to be safer to put it here where there's higher yields. So we're going to go ahead and, put our money here. Now the yields are dropping all the way to 4.372 as opposed to where it was before, 4.5. So that's a 4.2. So that's a 0.2% drop on this particular yield on the 10-year government bond, which is basically the risk-free rate. So when somebody says risk-free, what they're saying is that the government bonds are giving you an interest rate that is guaranteed. And what this is saying is that for every $95.50 that you put in, you're going to get back $100 at the end of the year, right? That's how they measure this in plain English. And then this one is the inflation rate. So this is something that the Federal Reserve looks at. But now that Kevin Walsh came into office, he said some very interesting things, and we're going to be talking about that in a minute. But this is basically telling us what is the interest rate of the inflation. So whenever we see rates going down, then we know that if the interest rate is going down, we're expecting the Federal Reserve to decrease the cost of money. But if they start to go up again, then we're expecting the Federal Reserve to increase the rate of borrowing. That means that if people expect money to be more expensive, then we are also expecting the market to drop in price because it's going to cost more to borrow money. So now they have to liquidate and shed some of the shares that they own, which means that now there's selling pressure because inflation is going up. Okay, so that's another marker to look at, and we're gonna talk about
Regarding
this more
cost
a little
of
bit.
the money, yeah, it will be really
Yeah.
interesting to hear because, a lot of people ask cost of money, how do you measure this? Like why exactly when inflation goes down, like this happens to the cost of money? Can you explain in depth more this mechanism? Because you explained it,
Yes.
but it was like very fast, I think, and
Okay. So
very high
yeah,
level.
we're definitely gonna explain that. But I wanna get to the USO benchmark, and then we'll just come back to this. So this is the crude oil, right? So now this is what's really interesting because we did an episode about 4 weeks ago now where we noticed that when USO was dropping, SPY was going up. So what is SPY? SPY is the S&P 500. USO is an ETF that follows oil. So we saw that when it was dropping, the S&P 500 was going up. Now USO is dropping, and the S&P 500 is dropping, right? And I don't know if you guys remember, but on that episode, I said this is not going to last forever. It lasted for about 14 weeks, and now the trend is gone. Now one drops, the other one drops. It makes absolutely no difference. But during those 12 to 14 weeks, whenever USO went up in price, the S&P 500 went down, and then when USO went down in price, within 4 hours, the S&P 500 was going up. Now it makes no difference. So that marker has disappeared and it no longer makes any difference. So that means that now all prices are essentially baked into the market, and we're back to a reset, which is what we're seeing here. This is basically a market reset. Okay, so we're gonna go back to the inflation rate and the cost of borrowing money, which was, your question. Um, how does this work? So when a company wants to do something, anything, they need cash, right? Cash gives you options. So one form of currency is the shares. If there is a very high valuation of the shares, that means that they can make purchases, like what SpaceX did when they bought Cursor. They bought it for $60 billion, but it was all shares. That means that they actually didn't take any money that they had liquid. So now SpaceX is still sitting in $80 billion, and they sold shares to do this. But like, let's say that you don't actually have shares like that. You have something else, and now you need to borrow money. Well, one of the things that people look at is cash flow. If you're spending more money to make payments on money that you have borrowed, you have less money available for your day-to-day activities, which means that you are more likely to be sued if you do not pay the people that you're borrowing from, right? That's why when I mentioned earlier about your bridge loans, if you don't pay those bridge loans, then the companies that you owe money to can easily come and take your assets. When the price of borrowing drops, then you go out and you borrow money from the bank at a lower rate against your assets, which means that now you can refinance and your cash flow will go up. So when the debt collectors come and say, we want you to pay us, you actually have money to pay us. You don't have to get sued, right? And
So
this allows you
basically,
to
the
have,
cost of money is like the fees that you will pay for the bank for the loans that you take, right?
correct. So the cost of borrowing is your interest rate. It's usually just very easy. It's like the interest rate that you're going to pay to borrow in order for you to meet your debts or to be able to pay for
Okay,
the
and
things that you need to do
how does it
operations.
work with inflation and deflation? Like,
Okay. So we're gonna have to go back to economics. But here's how it works, right? When the Federal Reserve sets a rate, that rate is set up on a quarterly basis. And whenever inflation is going up, the Federal Reserve comes and says things are getting too expensive. We need to take money out of the system. And just like from your laws of supply and demand, if there is less money available in the system, it's harder to get it, which means that now when you go borrow money, there's less money that's being put out. So they're trying to reduce inflation by doing this. So what does that mean? When the bank will loan money to the individual investor or to the companies, they're going to say the base rate plus a certain overhead percentage. That's why, like in Charles Schwab, it says base rate of 10% plus whatever the percentage is, right? So that basically means that you end up borrowing the cost of borrowing $100 is $110 a year. So that means that anyone who is borrowing $100 to spend, they already have to spend that money, plus they have to pay 10% on top of that. So their real value of those $100 that they borrowed is only $90 because $10 out of that is going to be paid in interest rates. So that means that everything that they want to do, they only have $90 to do it, right? Although they borrow at 100, they only have $90 available. So whenever the cost of borrowing goes up, they have less money available in order to run their operations. And if you have less money available to run your operations, you're going to have to get rid of assets. You're going to have to start liquidating. That means that you might have to get rid of a section of your company that is actually profitable because that could be the only section that you can sell in order to pay your debts and to avoid getting sued. So that's a very narrow explanation. But basically, if inflation goes up, the Federal Reserve increases the amount that you have to pay to borrow, which is the money that the banks are borrowing at. And so now they say, we're going to do base rate plus a certain percentage. So if the base rate is 4% or 5%, and their percentage is 2 or 3%, now you as the borrower have to pay 8% to borrow money. If you borrow over 10 years, that basically means that you're doubling what you have to pay, right? If you borrow 10,000 and you're borrowing at 8%, at the end of 10 years, you'll end up paying basically close to $20,000, I mean, Serhii can do the math on that, but that's more or less how it works. So that's why when inflation goes up and the federal rate comes back and says we're going to increase the cost of borrowing money, people get very, very nervous, and they basically say, okay, because the cost of borrowing money is higher now because inflation is higher, then we are going to reduce the amount of money that we borrow. And so this chart is just yearly, but here, if we go into this is basically what we're looking at right now. So this is like for the week. So you see here this little spike happening from April to May to June. So right here, the month of June went up, right? And it's not by much. It's like 2.35, 2.36 to 2.41, right? That's how much it went up for. So it's just a very, very small amount for the month of June. But the problem is that when this happens, you have panic sell, right? It's like a panic sell-off. So everyone goes in and they just start selling all of the shares that they have before someone else sells at a lower price. In my opinion, that's the wrong attitude, because we as the investors, if we don't need the cash right now, if we panic sell, we may sell at a loss. If you're selling and you're still profitable, good job. But if you're selling and you're not being profitable, in my opinion, you should have held, unless it's just a bad investment. That's how inflation works. That's how, the Federal Reserve a lot of times ends up making those decisions.
Basically, well, the way to regulate the system, how much energy is in each system, to take in money, to take out money, right, and move to another
Exactly.
systems. It's
Yeah,
pretty
that's
interesting.
basically what it is.
So,
And
and
that's
when
why we
some
see
changes
this here.
happen, so basically all the investors become a little bit frustrated, and which creates volatility, right? And a lot of
Yeah, it creates
people
huge
try
volatility.
to panic sell.
So that's what we see here. And then that's what we see rotation, right? So that's what you end up seeing in this particular chart. So that's why you want to be able to trim and sell. So if you enter into something that's like steady, like for example, if you were to let's go ahead and look at just VOO, which is Vanguard's S&P 500. Vanguard S&P 500. Let's launch this chart here. Okay. So if you notice this over the last month only, you see there's like a huge drop on this all the way down to $674. But if you follow it over 3 months, it's a spike, right? If you follow it over 6 months, again, it's a spike. If you follow it just this year, all of these charts show you that this is going up in price since it's starting more or less here in 2022. This benchmark has just been going up until right here where we see like it just kind of skyrocketed after March 30th approximately. That's when we start to see it going up. And now right now it's just stabilizing. If it drops all the way to $583, which I really doubt that it will, then this is gonna bring it back to the price that it was about 2 months ago. If it drops all the way down to about 465, it'll be a 12-month reset, right? So that's what we need to watch out for. Right now, everything that we see here is just sell off. Like everyone is just selling off, just like what they were doing before. Just like what happened in February, when the war was announced, we see the same thing happening here where people are just like basically panic selling. But the only thing that's happened lately is that Kevin Walsh is the new Federal Reserve Chairman, and he did not lower interest rates. And they basically said that they don't know when they're going to lower interest rates again. So in my opinion, this is a reset that is not going to last very long. We're also getting to the end of the month, which I'm thinking is when people have to pay their electricity bill. And that's probably why they're selling, because they gotta get some money out to pay their bills. But I really don't think it's gonna last. I think we're gonna see something like what we saw here, where it just like dropped for a bit, and then it just like skyrocketed again. So that's what I that is my prediction based on what I'm seeing with all of the benchmarks that I'm looking at.
Nice. Really
Yeah.
interesting. Really interesting. I have never thought that like paying for electricity bills makes people to go and sell assets.
I mean,
And yeah,
if you're looking
at
at
least
the
to have the
retail
noticeable
investors,
effect.
well, I
Hmm.
mean, no, that's just like an exaggeration, obviously. But yeah, people have to liquidate because they have things to pay at the end of the month. And so they're looking at, breaking in their profits, holding them in, and, waiting for the next cycle, right? And that's basically what we're seeing right now. People are just selling off, panic selling. That causes a reset. And, just remember that the stock market can be irrational longer than you can be liquid, which means that if you start to sell in a panic when you try to enter again because you see that the price is going up, then you're gonna buy high and sell low every time. But if you buy and hold, as long as you don't need the cash, then you're gonna be okay, right? That's what the market has shown us over and over and over again. That's why you see that these companies, like if we were to look at the all time for the stock market, this is the S&P 500 since 2011 until 2027. If you simply buy and hold, the market goes up. you know so it just depends how long can you hold for. And yeah, that's basically it. We went over a little bit by like 10 minutes. So this episode is about 10 minutes longer, but there was just a lot of ground to cover. As I said, in my opinion, this is only temporary. I don't think it's gonna last, especially now that you start to see that the VIX is stabilizing, right? I'm thinking it's gonna drop lower once people get used to Kevin Walsh and the way that he operates. But I think come July, August, things are gonna become stable, and then after August, we're gonna start to see a spike again. So if you happen to enter the market mid June, you probably enter at a very high price, and you're thinking like, I should sell. If you think you should, go ahead, but you would probably do better at watching the news before you make a decision. That will probably get you the best results.
This is interesting. How one
Yeah.
small change, like literally one position, one chairman in one organization, leads to so dramatic changes across all the markets.
Yeah, and I
Amazing.
think for me, like what I think is more that if you see like rotation of capital, right? If anyone ever pays attention to that, this is something that I actually pay attention to. Like I really like to see where money goes once it goes out from one system, what other system is it going into? Because this, at least for me, it helps me understand where I should be putting my money, especially when you see rotations like this. Like, I mean, this one is just, pretty one for one, right? Like utilities goes up and technology goes down, right? Utilities goes up a little bit and technology goes down some more. So which one actually happened first? Well, you would have to look at the numbers and come up with correlations. And you can actually make an argument for both. Like if you look at the numbers, an argument could be made for both. I think if we had more powerful computers, then maybe down to the microsecond, we might be able to tell which one happened first. But whenever I've analyzed the numbers, it's very hard for me to tell which one actually gave way to the other. They almost happen like instantaneously, as if money was pulling from one system and then into the other, unilaterally, like right at the same time. You know,
Yeah, most likely it is like this because all these actors in the system are trading their previous assets to the new ones, and this is like continuous process. So basically, it's like
possibly.
migration of the money from
Yeah,
one
very
asset
very
classes to
likely.
another asset classes.
It's yeah, it's very possible. It's very possible.
So it's like I think it's
Yeah,
happening at the same time.
it's quite possible. So that's everything that we have for today, everyone. Sorry we went a little bit longer than we usually like to. That is what we've seen in the markets today. So stay tuned for next week, where we see what is interesting and what to report. So Serhii, please go ahead and tell our subscribers what to do?
Yes, subscribe, like, ask questions which you are interested in, so we will be able to cover them in the next episode. And have a great week.
Thank you, everyone. Wish you all a great week.